Hey everybody, it's Larry Berman here. Yet another interesting week in the world and in financial markets. Let's dive into the chart room and see what we learned this week. The economic calendar told us that retail sales for the month of December was a bit higher than expected. Overall, though, um, when we looked at the market response early Wednesday morning, and the data came out hotter. Hotter generally means, okay, more work for the Fed to do, less rate cut excitement. Market sold off a little bit. By the end of the day, the market had reversed all the declines from the previous day. We had a couple of points this week where we saw similar price behavior. When something hits the market that ought to be negative, and the market responds positively, usually that's a very, very bullish behavior, the market anticipating some good news down the road. So with earnings season now fully underway, we heard from the financials, there were some misses and there were some beats. Overall, there was not a lot of concern yet. Wouldn't expect it with the economy still very much at full employment. When we look at the initial claims and continuing claims data this week, we saw yet again another strong set of data suggesting that rates should be higher and the Fed won't ease anytime soon. Markets again sold off a little bit on that and reversed. UMich came out, stronger expectations. Market tried to sell off, rallied strong to close out the week. So, is it the day trader that's back and the zero DTE options with gamma squeezes? There's definitely a little bit of that happening in markets. But, looking under the hood, trying to figure things out, I think a big catalyst this week has been in the AI space. Taiwan Semi came out. AMD, you're just hearing and seeing everybody in the market respond over and over and over and over to the same story. And so it's getting bubble-ish. We don't think we're there by a long shot in terms of, just craziness. There's definitely more room to go here. But when we, dig down and look at this ETF, which we like as one of the better plays on AI, it's not heavily concentrated. It's broad based. There's 80 plus names in the index. We can see from the peak in 2021 that the AI focused and technology focused ETF has not taken out the highs. So a lot of the good news is concentrated in the big names and in the semis in particular, because the semis are crazy strong now. Obviously, stand to be one of the biggest beneficiaries of AI. A lot of talk this week, some out of Davos around how powerful AI is going to be for productivity in the world. So a lot of excitement. There's much more news to come there, and it wouldn't surprise me if this keeps just chugging along. That said, when we look at the NASDAQ and again compare it to the peak, is this a bona fide breakout? Had some discussion this week with some of the guys on the trading desk around this, and commentary was generally that this is a valid breakout as after today. I've seen many patterns where you get these moves like this, looks like a breakout, and then you get a reverse. We'll see. But clearly there's a little bit more upside here to go in terms of the large cap tech names that could see us squeeze, call it 5-6% higher in the very short run before we would hit, a natural channel resistance area. When you make new all-time highs, it's very, very difficult to determine from a chart perspective. You don't have a lot of tools to figure out where the market might pause or reverse. And trend channels we found are as good as any. Some people like to look at Fibonacci extensions and things like that. We're not a huge fan there, but we do see from this perspective, if this is a bona fide breakout, there's a little bit more upside. Do I recommend chasing it? No, but if you're a short-term momentum trader and your time horizon is a couple of days or weeks at the most, then there's definitely a signal to be had here. One of the things that is curious to me is what's happened to start the year in fixed income. We had said late last year that long bonds and 10s below 4% seems unrealistic in our version of the world, where we see tremendous amount of treasury supply coming. So, we've seen in the last few months this very, very bullish trend for interest rates. Falling rates, long rates have come down. That's been a huge catalyst. Now, we've unwound about a third of that, as you could see, to start the year. Initially had a bit of a negative impact, but this AI news just keeps driving the money into tech. When you look at small caps, when you look at S&P equal weight, when you look at the broader consumer names, everything seems to be rolling over and tech is driving. So very interesting behavior here. When you think about trends and you look at this, you say, bullish. If you step out a time frame and say last year, you would say bearish, but maybe it's turning. Obviously, we had quite a peak there. If you take a 5-year view, there's no debate here that the trend is still very, very bearish for interest rates, with the caveat that we started at a very, very low yield. So we're just getting a bit of a normalization. And if you take a really big view here, one would argue that the bull market is over. We are in a bear market for bonds. And the question is, how does that play out? Because at a scale like this that's measured in decades, you can go for months and quarters where you get counter trend moves. And I would argue we're in one now. I don't think, when you think about interest rates and the pre-GFC levels we got to, so the US 10-year, when things were really, really bad, and rates were coming down, inflation was falling, the term premium on long bonds, the 10-year 4% was the floor. And it really wasn't below that until the GFC. And of course, what happened after that was QE. I don't think QE is ever going to go away as a policy tool, but no way, no how, anytime soon, before a complete economics collapse, are we going to see the Fed go back to doing QE. To me, that argues that it's going to be very, very difficult to push bond yields significantly below 4%. The supply that's coming demands a term premium, and that term premium should probably be somewhere between 4 and 5% on the 10 and long bond, if history is a guide from our version of the world. What does that mean for asset markets? It means they're very overvalued relative to the cost of money. But if AI continues to push the button, for now, that's the driving force. It is not a very strong economy, and it is not likely. There's an exuberance in terms of what rate cuts might come and what they ultimately might do. Fed has never cut interest rates with the economy at full employment. To think that that'll happen now seems unlikely. Anyways, that's the message of the week. That's what we learned from markets. Have a good one, everybody. Go Bills, go.